All right, good morning and good afternoon, everyone, and welcome to our webinar. Today, we're going to mainly talk about our Global Lending Opportunities Fund. So we're going to talk a little bit about the recent performance and the outlook. Specifically, we have our chairman here in the call, Laurent Jeanmart, who is going to share the views and the positioning of the portfolios and the opportunities that we see right now. But first, I just want to give you a very short introduction. I could see that we have some participants in the webinar that might not know us that well. So I'm going to do a quick intro to our group and to our fund. And I'm also going to give you a very quick update on what we see in the markets right now. I mean, right now, everyone is a bit a specialist in markets because we are all working from home. So we read a lot and we see a lot of news. And I think it's pretty crazy what's going on right now. I mean, you saw that probably April was the worst month in terms of economic activity in more than 90 years. And many economists expect that major economies are going to contract between 20 and 40% in the second quarter of this year. We also see that corporate earnings are contracting by more than 20% probably this year. And yet we saw a very strong market rebound in the month of April, which is really surprising. And we also see that valuation levels in stock markets, they have reached new highs. So I just want to give you very quickly my view on all this, what's going on, and then we can really talk about the potential winners and losers in the current crisis. So we really believe that the current environment is something that is not going to be solved that easily. I mean, there are some good news. So first of all, we can see that probably the virus was a bit less mortal than feared, and more people are probably already infected than we see in the official statistics. Second, we saw that the lockdowns have worked pretty well. So we didn't see an overload of the hospital infrastructure and so on. And governments are probably a bit better prepared now compared to the last couple of months. And also, there are new tracing possibilities right now. So, which basically means that after a very tough period during the second half of March and the month of April, in May, we can see, starting in Europe and now also in the US, that we can see that economies are slowly opening up again. But we really believe that in terms of economic activity, it's probably rather going to be a U-shaped recovery, because we are not going to go back to normal just like a switch. It's not like a switch on and off and on again, because there are some industries that are much more vulnerable in the current times, like everything that is related to tourism, everything that is related to events, also for retail, restaurants, and so on. We have new health protocols. So it's going to be a slow pickup. We can see, for example, that airlines are planning to ramp up the capacity or the flights with 10-20% of the usual activity, which really means that it's going to take some time until we really recover. And we believe that a full recovery in terms of economic activity, we're probably only going to see once we have a vaccine for the virus. And the most reasonable assumption is that this might be the case, hopefully, somewhere in 2021. So we're really talking about the U-shaped recovery. The markets, they already the V-shape almost. So it's only down 10%. And we believe that we're going to see further correction because it has really gone too fast and too far in terms of the rebound. And we believe that it's going to be a very volatile ride. And also, if we look at capital market assumption, more like given the valuation, the economic prospects that we have for the coming years, political tensions, because now we are also in the blame game that everyone is defending their own national interest and it's the fault of the other. We're going to have some disruption in terms of supply chains, more government debt, more corporate debt, more consumer debt, and so on. So structurally speaking, probably economic growth is going to be slower. And if we look at the current valuation level, it's reasonable that over the next couple of years, 5 to 7 years, most likely equities are not going to return much more than 5% per year. Of course, there are winners and losers, as we all know. We see now that we are all becoming experts in terms of homeschooling and Zoom and everything that is related to e-commerce, everything that is related to electronic payments and so on. So there are certain industries that are certainly going to be the winners, because we now feel more comfortable to stay at home, to order stuff at home, and so on. We're probably going to travel less. We do more online meetings and things like that. So, I mean, there are winners and losers for sure. And we really believe that, that investors really should start to look at the winners for the next couple of years and try to avoid the losers. One of the winners in our view is also robotics, automation, and so on, because there's more proximity sourcing. People are concerned about frontiers, borders, cross-border supply chains, disruptions, and so on. So that's going to be very, very interesting times in the next couple of years. But also we really very strongly believe, and we have seen it also in terms of the performance over the last couple of months, we can really see that one of the clear winners is also the whole private debt segment, because we saw it after the great financial crisis in 2007 to 2009, that banks started to retreat from lending to the private sector, especially to small and mid-sized enterprises. This basically opened a huge gap, a hole for the private market to step in and to lend to the private market. And right now in this crisis, I mean, we can really see that the banks are not going to be blamed for the crisis again, because this time it's really an external shock. That's also why we see a lot of stimulus, fiscal and monetary stimulus right now, because it's really not the fault of anyone. So everyone should be saved. But at the same time, banks are going to feel the pain, because right now we see that maybe in the US, the Fed has solved the liquidity crisis in the short term, because there's really not a liquidity crunch given the very aggressive monetary policy. The same we can see in Japan, in Europe, and so on. But it cannot fully solve the solvency issues. So there are going to be defaults, there are going to be companies that will not survive during the crisis or after the crisis. And most likely banks, they continue to be very cautious with their balance sheets. We are seeing it right now. Laurent will talk a bit about it afterwards in terms of different regions and segments. So we're seeing it now that a lot of very good companies, very high quality assets, they don't get bank funding, and it really opens excellent opportunities in terms of private debt and funding for the private debt market. Just very quickly, I mean, probably you all saw the update that we sent. The Global Lending Opportunities Fund had a positive performance in March. It was up 0.2% for the institutional share class, the US dollar institutional share class, which is pretty remarkable in our view, because March was really the month where everything else corrected massively, as you also can see here in the chart on the screen. I mean, really, when we designed the portfolio of the Global Lending Opportunities Fund, it was really meant to be extremely robust and resilient during all times, and we have the first proof. So during these very stressful times, we continue to have a positive performance month by month, and really very, very low volatility. Remember that the Global Lending Opportunities Fund, we are basically invested in strategies that are very well diversified across the globe, and also in different segments. And the focus is always relatively short duration. You know, we want to be relatively liquid. We only do lending in areas where we can get very strong protection through collaterals, guarantees, personal guarantees, and sometimes even insurances. So this basically means that in times of the crisis and in times of uncertainties, you're very well protected. And even if a company goes out of business, you're the first one to get the money. So really the risk of losing money is extremely low. So with that, I just want to invite you as well to ask questions. We want to try to make this webinar as interactive as possible. So you have a Q&A tab in the Zoom application or on your screen. So please type in questions that you might have for me or for Laurent. In the meantime, as we are waiting for questions, I will kick off with the first question. And I think this is a very important question, because usually during stressful times, a lot of funds, they get into difficulties because investors sometimes not only sell bad assets, but they also sell good assets because they need cash, or because they need liquidity, or because they get margin calls, or because they need money for their private businesses and so on. So my really first question is to Laurent. What have we seen since the start of the crisis in terms of redemptions, and how is your feeling in general in terms of our investors and the comfort that our investors have with our fund?
Okay, thank you very much, Pascal, for this neat and precise introduction. We're certainly living interesting times, and we're trying to make the most of it, really. We are in constant touch with our peers in the industry. At the end of the day, there's not so many private debt funds out there, and we like to keep in touch with everyone. Basically, the conclusion for this is that maybe somewhat surprisingly, we haven't seen any redemption in our funds, and so we're very proud to essentially to for this result, and to have investors that trust us even in periods of high stress. It's been a very satisfactory for us to see that. So that's the first point. The second thing is not only we haven't seen any substantial or any redemption at all, but the month of April in terms of new subscriptions into the fund has been, I think, the second best month we've ever had. And although we thought that stress points like this in the marketplace would lead people to understand maybe a bit better what private debt can offer, we didn't expect this to come that early. So it was, again, surprising and very satisfactory and even humbling to see that people are trusting us with their money in times like that. So that's a very positive point for the fund. I think more and more people understand that we offer a truly non-correlated strategy. We're not going to be one of these funds making 50% in a given year, but for us to lose money in a given year, it will take probably much more than the current crisis that we're living. And for us, it's really very much our value proposition. We want to deliver something that that's not correlated to the market, that's not correlated to other assets, and that provide not only protection when investors need it, but also performance. So that's basically where we stand with respect to redemptions and the cash position of the fund.
Okay, perfect. Maybe another point that I think it's very important to discuss is basically the performance that we achieved over the last 2 months, and also to give just a small update on what has changed in the portfolio and how we positioned, knowing that we are going into a tougher economic environment, and how basically we believe that this is going to evolve over the next couple of months.
Yes, absolutely. I mean, since the beginning of the crisis, maybe it's that's how we react when we've been in these markets for a very long time. But basically, I think for us, the most sensible course of action, regardless of what was happening in the portfolio, was to raise cash where we could. So when the crisis started to really accelerate, we put on hold any new investments that we wanted to make in the portfolio, and where we could, we basically wouldn't recycle the capital. So, for example, in the most liquid parts of our portfolios, for example, factoring, we tend to have cash coming back to us pretty much every single day. We took the decision to be once again, very conservative, to retain the cash, not recycle the cash, and basically wait for the best opportunities to show up. And we basically, essentially, starting to see that. We're starting to see people coming to us with very interesting opportunities, opportunities that come with high levels of protection, pretty high return for the risk, and we are, I think, best prepared to seize this opportunity. So we're going to start slowly redeploying the cash. But I guess that we've been playing defense. I think in times like this, when the opportunity is very high, it's probably best to do that. Now that the horizon is starting to clear a little bit, and that we see a little bit better how we're going to get out of this crisis, it's probably time for us to start redeploying this cash into one of those very, or some of those very interesting opportunities. The second thing, yes, please.
I hope that you can all see the chart on the screen. So you can basically see the allocation that we have to different strategies right now. So as Laurent said, right now we have 10. At the end of March, we had 10% in cash. Now it's actually 15% that we have in cash. Based on what Laurent said, that we had some subscriptions in the current month. So or in the month of April, because now we already in May. It's incredible how time flies. So do you expect that we continue to hold this cash, Laurent? Are we really starting to see good enough opportunities to start to deploy the cash right now?
I think, when we started raising cash and doing that a few weeks ago, that we wouldn't be allocating cash to new opportunities for some time. What we try to do is essentially be best positioned when the time comes to redeploy cash, to invest in opportunity. In terms of activity, we've been very times on in the best opportunities in terms of yield, but perhaps even more importantly, in the most defensive investments. So I expect the cash to be coming down in the next few weeks, slowly, and then hopefully, if things go according to what we are told, they're gonna be. I'm expecting that around maybe the end of the summer we'll be once again fully invested in a portfolio that is probably going to be slightly higher yielding than what it used to be, but perhaps even more importantly, even more defensive.
Okay, perfect. Maybe we got some questions before the webinar related to the recent performance. I mean, we were extremely proud and happy with the performance because it really shows no correlation. Nevertheless, the performance in March was a bit below average. So you mentioned the cash. Is there maybe something else that investors should know that explains the performance in March? And what would you expect in terms of returns for investors for the rest of the year?
Sure. No, I mean, by a very large margin, the reason why the performance was a bit lower in March was because of the cash position. Obviously, in the current markets, when you have cash, it doesn't yield anything. If anything, if you have euro, if you own euros or Swiss francs, for example, it costs you money to have it at the bank. So that's been a drag. I mean, we were prepared to take that slight hit to the portfolio again for the sake of playing defense and be best positioned to take the best opportunities. But by far and large, it's been the main driver of the lower performance, although positive performance in March. We've had, when you do factoring, you always have like a natural level of delinquency, which is around 1% in the portfolio. We have seen a slight increase in that, mainly for technical reasons, but at the same time, we've seen already an increase in the cost, the rate that we're getting in factoring. So all in all, it's been a wash. There hasn't been any significant impact in the portfolio, and basically, the reason why it's a bit lower is higher cash.
Okay, perfect. Thanks a lot. I mean, what do you say is for the next couple of months where we see the most potential? Where we see really the strongest opportunities for new cash that is coming into the fund.
Sure. So I think when we design the Global Lending Opportunities, what we had in mind really was a portfolio that would be performing well, but also that would have almost some embedded option if things go bad to seize the collateral and sell it at a profit, at a significant profit for the benefits of investors. And I think that's been a very important sort of aspect of what we're trying to do. If things go bad, then we get a very disproportionate amount of assets in favor of the portfolio, and then we can realize those assets and maybe make even more money. What we are seeing now is an opportunity to do a bit more of the same. So trying to get the assets that give us a very large amount of collateral. We are seeing some very interesting opportunities in factoring in developed countries. For example, in the UK, there's very large demand for financing NHS invoices at rates that are very, very high, in excess of sometimes 2% a month. That we've never seen that before, and you can tell that some companies really are in need for cash, and we are ready to buy their very high quality short-term assets at a very low price to help them. That's interesting. We are also reasonably heavily invested in real estate, so bridge type of opportunities. What we're seeing at the moment is, rates haven't really gone up very much. So we're getting about the same rates in the market for the capital. But what we're seeing is much better protection. So the loan to value on average that we're getting on new opportunities is sometimes 30-40% lower, which means better than what we used to have. So the amount of protection that we used to get in our portfolios for our loans used to be on average before the crisis around 140%, give or take, or 150% of the loan value. Now we're seeing significantly higher levels than that in the marketplace. So I think this is where the opportunity is. We're not in the business of trying to make big returns. I think that if we have high single digits on that basis to our investors, it's always been our target return. But it's an opportunity to make the portfolio even more defensive, and on the margin, of course, pick up a bit of yield. But that's basically where we look to allocate the capital.
Perfect. So I got a question via WhatsApp. So maybe it's a bit tricky to type in the question directly in Zoom. So it's a very obvious question because we are still, in the coronavirus and economic stress. In some markets, it's a bit more severe than in other markets. So if you look at the portfolio right now, what do you say is the biggest risk that we are facing?
I think the risks that we're facing are essentially the same as the risk we were facing before. If I had to identify, one of the biggest risks that we have is a very, very significant drop in the value of the collateral we benefit from in our deals, so mostly real estate. Real estate is, at least where we invest, is very stable. The market's very stable. So we're quite active outside London in the UK. And the market there has been very stable. So it hasn't gone up at all in the last 10, 15 years. It's been very, very stable. But the good news is that in times of crisis, it hasn't really gone down very much. So it's in that context that we need to appreciate the fact that the main risk is if we see a drop of 40 to 50% in value of real estate, then we start losing money. It's not as if we wiped out, but we start losing money and our principles starting to get impaired. That is a scenario that we see as very remote, to say the least. Everything that we're seeing at the moment in the marketplace indicates that prices haven't really moved in those regions where we're active. Of course, this can always change, but so far it's been very resilient. But it remains one of the main risks, massive contraction in value of real estate in those regions. This is what we're exposed to.
Perfect. Thanks, Laurent. I mean, I got a question via the chat that is saying, can you talk a little bit about the metrics of the fund, such as standard deviation, duration, performance, and also give us a bit more an update on what are the minimums to invest, the fees and so on, and the classes that exist to invest. I mean, maybe later on we can send our Q1 report where we have some more statistics on the performance and on the different risk metrics. We have a small chart here where we can see at least the risk and return of the fund over the last 3 years. I think maybe you can give us a bit more details on the performance characteristics and the way to invest for investors.
Of course, yes. Starting with the risk, the standard deviation of the fund is very low, simply because we never had a down month, which makes that metric very compressed. So I would say, I mean, I don't have the exact figure in mind, but it's around 1% a year, which is about 20 times lower than equity risk, for example. If I take the S&P in recent times, so it's very conservative. It's much less volatile than bonds as well. Of course, bonds tend to have a volatility of about 5% a year. Again, our volatility is around 1% a year. If you just take the ratio of these two numbers, basically the conclusion is that our fund is probably 5 times less risky than a sort of mid-duration, high-quality bond. So we don't foresee any increase in the standard deviation or the volatility of the fund in the short term. In terms of the duration of our loans, the strategy of global lending has always been to build a diversified portfolio of opportunities. We've always had a significant amount of capital invested in factoring, which is by nature is basically the process of buying invoices from companies to finance those invoices. That's an activity that has an average duration of between 30 to 60 days. So we buy invoices, and by the time we deploy the capital, it takes about 30 to 60 days to have the capital come back. And depending on the market, where we are in the market cycle, we have between 10 and 35% of the portfolio exposed to factoring, which is always a great source of liquidity. And then the rest is really, probably dominated by our exposure to real estate, where we do loans always less than a year in duration, and that's the duration that we take when we start the loan. So those loans tend to be refinanced very often, or purchased. The projects finish sometimes before the expected deadline. So the effective duration, the realized duration of those loans is significantly lower than a year. So our liquidity profile is pretty good, and I've spent some time in insurance, and I'm very aware of the necessity to optimize asset liability mismatch. And I think we have a really very good liquidity profile, and I expect this liquidity profile to stay the same or improve in the near future as well.
Maybe I'm not sure whether everyone can see the screen on the phone and on the laptop, because Zoom is sometimes it's a bit interactive. So you either see the camera or you see the screen. Sometimes you have to click on it. But on the chart, if you can see it, you can basically see it's not the duration of the fund, but it's the liquidity profile, where you basically see what percentage of the fund can be liquidated in specific time frames. So you can see that we have basically 80% of the fund that if necessary, would be liquid within 6 months. So the portfolio is extremely liquid. And of course, if we are in times where we have a bit of stress and also good opportunities right now, I think it's a huge advantage that we have in the Global Lending Opportunities Fund, because let's say investors that invested in the last 2 years in bonds or direct loans with a duration of 5, 6, 7 years, obviously they got locked and they cannot really take advantage of the current situation, especially if there are funds that haven't raised new capital. And as Laurent rightly said, because we have had a lot of maturities, especially in the factoring space, where we also decided to reduce the exposure, we have a lot of cash that can be used for new opportunities and better opportunities, because right now probably the opportunities are much more attractive than last year. So it's really a big advantage to have a fund that has a very low duration on the one hand, and on the other hand, we don't depend on secondary markets. You know, we don't have to sell any securities in the secondary market, which means that there has not been any stress in the portfolio during March, which is also the main reason why the performance has been positive. So I got another question for you, Laurent, and it's really related to the previous chart that I think I showed it a couple of minutes, is where we can see the target allocation by region and sectors, but investors, they also saw the return objective. You know, I think I mentioned it at the beginning, the target return is 8 in USD, institutional class. We have also other type of investment. I think we prefer to send all the details on the different share classes, maybe via our fact sheets or via email, because really we have euro, US dollar, we have retail, institutional, and we have always accumulation and distribution. And every class has a different type of characteristics in terms of fees and return expectations. But if we look at the USD institutional share class, we have a target return of 8, and if someone chooses the class with distribution, we have a dividend of 6% that is paid quarterly, so 1.5% every 3 months. And I got the question whether after, you know, given the current situation where we have a bit a tougher economic environment, do you still expect to achieve 8% in fiscal 2020?
Yes, good question. I think we do. Of course, you know, because we've been playing defense so much in the last couple of months, we've fallen a little bit behind the target. But at the same time, as I said earlier, I think we're seeing some extremely interesting opportunities with, you know, at the same time, lower risk and higher returns. So all in all, I think, you know, unless we see something unexpected happening by the end of the year, if we see things normalizing gradually, let's say by the summer or by Q4, at the beginning of Q4, we expect to be hitting the target for this year again. So 8% net for investors for the year.
Okay, perfect. Thank you, Laurent. I think for the time being, we don't have additional questions. If you have additional questions, just contact us directly. As I said, sometimes it's better to have a direct conversation. Also, we have a very good marketing material, I would say. So in terms of fact sheets, commercial presentation, Q1 report, and so on, we try to be as close as possible to our investors. And as Laurent said, we are extremely proud that our investors have an enormous trust in us. So we continue to grow during time where other managers have had some issues and some troubles. So I think for us, the relationship that we have with our investors is extremely important. So don't hesitate to contact us anytime, and we can give you all details. Very important also, I mean, we obviously hope that soon we can start to travel again and visit our investors, but now most of us continue to work from home. I mean, I think in London you still have to stay at home, Laurent. Here, I'm currently based in Panama, so in Panama we're probably going to work from home at least for another month. So which gives a good opportunity at least to have phone calls and conversation with clients. So just contact us if you need anything. If you have additional questions, you can send it via email, WhatsApp, whatever you prefer. And very important, stay safe. Thanks a lot for your time and for your interest. And hopefully we talk to you soon.
Thank you everyone for attending.